Everybody, this is Jim at freechartvideos.com, and I am on the road again and do not have a nice little disclaimer page at the front of this video, so I'll just say it. This video is for educational purposes only. It is not intended to be used as any form of investment advice. I can draw lines on charts, but you have to draw your own conclusions from your own due diligence and make those investment decisions that are suited for your personal financial situation. I'm not a licensed professional. I'm just a guy who draws lines on charts. So let's look at the S&P 500. Yesterday was a really, markets really got slammed, and that really kind of caught me by surprise because we had gotten over this top line here. Hold on, let me change that from the eraser. We'd gotten over this top line with what looked to be a breakout, but that failed. You might call it a premature false breakout. We'll know which it is soon. If it's a false breakout, then this pattern that we've had over the past 4 weeks ends up just keeping on going down and maybe even breaks down to the downside. If it's a premature breakout, well, then that just means it happened sooner than the real one, which has yet to occur. I see signs that the S&P may be headed back for that top line that is currently highlighted. I'll get into that in just a second. But right now, one thing I want you to keep in mind. A lot of the bears are really excited because we have been trading down for 4 weeks. I will remind you that even at the low of today, roughly, let's call it 1308, at the low of today, at 1308, the market was off 62 points from the high. 62 points, that's about 5%. So what we have seen over the past month, even though it has felt drastic times, we have had roughly a 5% corrective move in the markets. And it has not been particularly steep or particularly violent. The only time it felt violent was when we had that breakout right here that took us up and out of this pattern, and then in one day we gave all of that up and got ourselves back down to the previous lows in that pattern. Today we came very close to tagging this bottom line, and it appears that I don't want to say it quite yet because there's some things that have yet to happen to confirm this, but it appears to me that that bounce is as good as the bounce on that bottom line. And let me show you why. If we go in and look at a 5-minute chart, we can see that the downtrend that started, and I'm not starting it up at the very top. I'm actually giving this a little bit more technical, what's a good way to put this? If I start all the way up at the top there, then it's real easy to show a broken downtrend because that creates an artificially high starting point for it. I move this line actually to right here because so much lines up with that when we put it about there. So it appears to me, to these eyes, that today we got out of that downtrend line, came back, looks like maybe sort of a back test, and I'm not going to call this another inverse head and shoulders quite yet because it's not. However, this is a level we need to watch. That level is, let me get to my little tool here. What is it? Roughly 1317. To be on the safe side, call it 1318. That is a level to watch. Why? Well, because if we break out over that level, then this whole little thing that broke that downtrend looks like an inverse head and shoulders. That will be the breakout. And if you measure this pattern, and I'm almost reluctant to do this because we've seen these guys not behave a couple times, but it is what it is, and until it fails, and you can see that if this does come up over that line, then it is setting up a move to at least retry that top line. So, I'm not in panic mode. Additionally, I want to show you on a 2-day chart here, this line drawn from the market low across the right shoulder on that inverse head and shoulders. And if we zoom in, we'll see that that's right about where the market bounced today. So, I don't like the fact that this is happening as someone who is who thinks that this bull trend should continue. But if it doesn't, it doesn't. The good news is where we sit right now in this market is a pretty good spot. And bears, you're not going to like this. Pretty good spot to go long, because there's not that much room underneath you that would serve as a trigger to let you know that this market may be headed for a more serious correction. In other words, the best place to buy is at rock bottom support, and we're not that far from that. Would be this line here, roughly around 1300. Let's back out on that chart. Sometimes these lines move around a little bit. Let's zoom in on the daily charts. I know that things staying put there. Yeah, roughly 1300. So at 1312, it looks like we may turn up. If we take out that line, then there's a chance that that becomes the legitimate breakout. And it seems like this market just wants to go sideways a little bit more. It needs to bring in some more buyers, and it needs to wring out some more profits. And that's the whole thing that creates channels anyway, isn't it? It's people who take profits at the top and then buyers who come in the bottom. So today the S&P was down marginally, not bad at all, really. And it looks like this may be, if we look, oh, by the way, if we look at a daily chart, those of you who like candlesticks, it's a little hammer. I don't know, some might call that a spinning top, but the idea is certainly an area of indecision, and at a point where one would expect some indecision. So look, that is the S&P update for today. And like I said, I'm on the road, and I apologize for the quality of this video compared to what I usually put up. I hope you get something out of this, and take care. The video tomorrow will after tomorrow's close, will be posted sometime over the weekend. Everyone take care. Thanks a lot for watching and listening.